Hello everyone, welcome to Blue Dragon Actuarial. So today I am going to ask a question that Mr. Kartike Gupta has asked. You can see that he has mentioned that I open just a quick question, and that is on market consistent valuation series, 5-minute series. So he asked that just a quick question, while watching your video, you mentioned about risk margin. So my question is, when the company is already holding risk-based capital or SCR to why it need to hold the risk margin separately, right? Or you can also ask the reverse question, like why the if the market is or the company is kind of holding the risk margin, why is it holding SCR, right? Both the case, right? And until then, I mean, yeah, he was kind of saying that you will wait, and it has passed like 3 weeks have passed because of different things. I was not able to answer it quickly, right? So today we are going to answer that question, and we'll take the reverse approach, right? So why, when in a market, when a company is keeping risk margin, why the company is kind of holding the SCR, and that would I mean automatically answer the question why the company is holding SCR when there is, and why when the company is holding SCR, why the company is keeping risk margin. In fact, this approach, like why when the company is holding SCR, why it is holding risk margin, it is kind of like it is not the correct way of looking at it. The first, the company needs to hold the technical provision or the liability, and then the company need to hold the margin. So that's why I'll approach this question from that direction. It's not that the company first hold SCR and then it holds the technical provision. The company first hold the technical provision, then it holds the SCR. So that's why that question in itself is slightly on the wrong side. So what I'll do is I'll try to answer why both of, like, what is the importance of both of this item, right? So that why separately they are kind of required, that would be kind of cleared, right? So let's move on to the topic. So the topic, as we can see, is why solvency capital is required, right? When there is risk margin or vice versa. Same thing, right? So first of all, we have to understand the liability structure in Solvency 2. So liability structure is in Solvency 2, the liability is called technical provision. It is not called liability as such, right? In like when that's how it is kind of spelled. So technical provision, they have split into two parts: hedgeable and non-hedgeable. Hedgeable are those which are whose value can be determined for the market, like for whom the secondary market exists. As for example, in shares, right? You're purchasing the share and you are selling the share every day, so there is a price at which you are doing that. So that is market valuation, right? That the price for that exists. And if some life insurance liabilities like that, that ready-made price exists for that in some secondary market, that is the market valuation. However, for most of the life insurance liabilities, such kind of thing is not possible. You cannot measure the like there is no instrument in the market which will give you the benefit of term product, right? That's why term products are sold. If there is other instrument, why would term product be sold? And that's why there is no market valuation available. Somewhere in the UK market, you can sell your policies, life insurance policies to other, and there some amount of valuation can be done. But other than that, I mean, especially for Indian market, nothing like that works. So not most of the life insurance liabilities are there for non-hedgeable, right? And that non-hedgeable part is also split into two things, which is the best estimate liability and the risk margin. So best estimate liability, you take the best estimate of mortality, lapse, expense, and then you project it and then discount it to calculate the best estimate liability, right? And risk margin is something, some amount that is kept over and above that, right? So here, and that those are discounted at the risk period. So here I'm not going to go into why it is discounted risk period. I've already covered that in that video where Karthik was kind of asking that question. So let's move on, right? So what is the definition of risk margin? So risk margin is intended to increase the technical provision. So you have to understand this word. This word is of paramount importance. Increase the technical provision to the amount that would have to be paid to another insurance company in order for them to take on the best estimate liability. So this is, so what best estimate liability is already a liability, right? Now suppose there is two companies, insurance company A and insurance company B. And insurance company A is holding the best estimate liability. Insurance company A wants to sell their liability to the insurance company B. Now in this case, they are selling the liability. They are not selling asset, right? So if you sell the asset, you will, as a seller, you will get the amount, and the buyer will have to pay the price. But in this case, you are selling a liability, right? So that's why as a seller, you have to pay the amount and buyer will receive the amount. That's because the thing that you are selling, that is getting changed, right? Instead of selling an asset, you are selling a liability, right? Because the buyer is taking on the liability from you, it's more of an headache for him, and the headache is going away from your side. So that's why you have to pay, right? You are not adding value to the buyer. By selling an asset, you will add value to the buyer. The basic concept of economics. So in this case, you are not adding value to the buyer. In fact, you are reducing the value from the buyer. So that's why you have to compensate the buyer by the amount of value that you have reduced, right? Now, since this is best estimate liabilities, this is a best estimate, right? It can be incorrect as well. It may not follow the best estimate. So there will be a theoretical extra compensation that would be required by insurance B in order to purchase the liability from insurer A, right? Because otherwise there might be things might go wrong. The best mortality might follow best estimate, labs might not follow best estimate, right? So who would pay for that? Why would insurer be kind of knowingly accept such kind of thing? And that's why the extra capital or extra amount has to be paid to the insurer B, and therefore that's what is written in the second line. It represents the theoretical compensation for the risk of future experience being worse than the best estimate, right? As I mentioned, the mortality can be best estimate, right? But the labs can be worse than best estimate, or the reverse. Mortality can be worse than the best estimate, but labs can be better than the best estimate, or labs can be at the best estimate level. And for the cost of holding regulatory capital against this, so there is also the opportunity cost is also kind of involved, because those amount has to be kind of invested in bonds, and they cannot be invested in equity. There is a regulation against that. So there is opportunity cost, because if they could be invested in equity, they would earn higher capital. So risk margin represent both this component. The main important thing is for us is the theoretical compensation for the risk of future experience being worse than the best estimate assumption. That is what the crux of risk margin is. And also it holds the opportunity capital, right? So this amount of opportunity capital you will be losing by kind of investing in bonds and other regulated instruments. So that's what risk margin is. So what risk margin does, it increases your reserve. So earlier in IFRS 4 we used to have prudent reserve, right? So instead of keeping 100, we used to keep 120, 20 being the margin. In this case, what they have done is they have split the 120. So they have said that best estimate liability is 100, so we'll keep that separately, and 20 is your margin, right? And that's why we'll keep the 20 separately. We'll call it risk margin. That's the kind of the intuitive way of understanding that. But the mathematical or the more theoretical definition would be this: that you are selling your liability from to another insurer, and because you are selling liability, you are reducing the value for that insurer. If you are reducing the value for that insurer, you have to compensate the insurer, right? In this case, the seller has to pay the buyer, right? So I hope that portion is clear. So risk margin is part of the liability. That is a very important statement. Just keep it underlined in your mind that risk margin is a part of the liability of the insurer, right? Like reserve in IFRS 4, reserve was the entire liability. So in this case, risk margin is the liability. Risk margin along with the best estimate liability, where the liability what is already there, but risk margin, the liability what is not there. So risk margin is the liability for the insurer. What is SCR? Now, SCR is a value at risk measure. So value at risk measure means that what is the maximum amount you can lose, right? So you can see that there is a 99.5% confidence interval. So that means that for those events which are unexpected, which would not occur, like in 99.5% confident with confidence, you can say that the money that you are keeping would be for any event that is kind of normal expected, would make you lose money, that would be covered under this scenario. But there might be one event which will lie beyond this, right? Maybe 1 in 1,000 scenario or 1 in 10,000 scenario, that would might dent your capital. So the SCR is like you cannot cover 100%. There is nothing as such, right? There is no probability like that, right? So something can happen, or like COVID, it happened. Russia Ukraine war, we never had a war in the last 50 years, I believe. But then there was a war, Russia Ukraine, which is still lasting, right? So COVID, Russia Ukraine war, these are unexpected events, and these are the SCR is kept for those sort of things. Now, what is value at risk, how value at risk is calculated, those details I'll avoid here, right? So if you want to know about that, you can write in the comment section that I want to know more about the value at risk measure, right? Or you can also Google and you can find that out. So when for some unexpected events which rarely occurs, where there is no existence of that in the maybe past 500 years or so, and those kind of events occurs, then we have to use the SCR, right? So SCR is capital. Like risk margin was part of the liability, SCR is part of the capital. Now, who provides capital? The shareholders, right? Shareholders provide the capital. So SCR is provided by, initially the SCR is provided by the shareholder, right? And like the shareholder provides the capital, a portion of it would be ring fenced, or would be said that this is the SCR portion, right? So don't touch it. Remaining portion would be the free capital you can invest in equity or whatever. But this is SCR. We need to keep it separately, and maybe we need to put those in once again the regulated bonds and everything. So SCR also have an opportunity cost of capital, right? So that's the reason for which SCR is kept. So SCR is part of the solvency capital, is part of the capital, which is kind of provided by the shareholder, and the best estimate liability or risk margin are part of the liability in solvency too, which is where the the claims and other things comes into picture, right? So both these are part of different components. If you remember the balance sheet equation is equal to asset equal to equity plus liability. So in this case, the asset is constant, but the liability will represent the risk margin plus best estimate liability, and the equity would one portion of the equity would consist of the solvency capital. Okay, let's move on. So why SCR is used mathematically? What is the reason mathematically SCR is used? And we'll also have an intuitive understanding why SCR is used. First is liability in insurance does not exist physically. Right? What is the meaning of this? Like, for example, if you have like my famous example, chocolate. If you are selling chocolate, then you need to have a factory where you need to process chocolate, you need to create chocolate, you need to melt something, you need to solidify something, etc., etc., right? So those entire factory, the inventory that you are keeping, those are your liabilities. You have physical existence of liabilities, right? But in life insurance, how can you determine liability? You cannot say that I know this many people will die. There is no way for you to say that. The science and technology has not advanced that yet. Maybe in future you will be able to say that, but otherwise right now there is no possibility of saying that. So in this case, liability in insurance does not exist physically, right? You cannot touch it. You can only know that yeah, there is a liability that is existing, and that's why actuaries are required, right? You only know there is a probability of that, but in 1 year the liability might be zero as well. None of the people has died, right? But in 1 year the liability can be more than what you have expected. You probably expected 10 people to die, 20 died, right? Like the COVID year, something like that can happen, right? So liability in insurance does not exist physically. So that is why we did determine it mathematically. I have repeatedly told in my channel before also that in profit, the variable for reserve is called mathematical reserve. The reason it is called mathematical reserve is because it's determined mathematically, right? There is no physical existence of it. So we have some asset, we are keeping aside some amount for the liability, we are investing in bonds, etc., etc. How the nature of the depend considering the nature of the liability, and that's why it is determined mathematically, right? There is no physical existence for it. Now, so it's an expected number, obviously, because you are projecting something based on your best estimate, etc., etc. But it is not an actual number. The actual number will differ from the expected number, right? So I think that much is clear. Now the balance sheet equation, as I mentioned, that states that asset equal to liability plus equity, basic CB1, I believe right now, or for our purpose it was CT2, right? So asset equal to liability plus equity. This is the basic balance sheet equation. I hope you will remember this. Now here asset is an actual number. Why asset is an actual number? Because in Solvency 2, it is you are calculating it on market value basis, right? You have seen the Solvency 2 liability structure where they had some portion of the liability as hedgeable, and that was being calculated on market value basis. So asset, obviously you can determine the number, the equity share example that I gave, right? So asset is kind of determined on market value basis, but liability is determined on expected basis, and its market value or its actual value can be something different, right? So what would happen in order to deal with unexpected liability when the unexpected liability is greater, like in COVID scenario, right? In COVID situation, the liability increased, and you probably have different expectation, but liability increased because of more deaths or more claims, right? Because of more health issues. If you are selling a health insurance riders, right, for a life insurance company, the liability increase. Equity has to reduce because your asset is constant. You cannot change your asset, right? Your asset at a point of time is constant until unless the shareholder pumps in money from outside, the asset cannot change, right? So your asset is constant, your liability is increasing, right? And then something has to reduce, right? Otherwise this equation will not hold. So what can reduce? Equity would reduce, right? So hence SCR is kept as part of equity, or in this case capital, to handle unexpected events. So liability or risk margin is used to handle expected events, right? So if you are saying that I expect 10 people is going to die, right? And you know that maybe there is a chance that 12 people might die, 15 people might also die, because 15 that is your best estimate is 10, but you know that there might be a difference here and there. 12, 10 can become 15, 10 can become 8, etc. That is okay, right? That means that your expectation has not been exceeded by much. But suppose 100 people dies, some unexpected event happen, so for that SCR is kept. So SCR, so when expected events is happening, and if it is slightly off from the best estimate, risk margin will take care of that. But it was extremely unexpected, right? Something which is not seen in last maybe 100 years, like COVID, like Russia Ukraine war, then SCR would come into picture, right? So I think the mathematically it also makes sense. The liability is the expected part. If the actual liability is very huge, is is nowhere closer to the expected liability, then the equity has to reduce. And what in equity has to reduce? In equity can be split into, say, free equity or free capital and the SCR. The SCR portion has to reduce, right? Because some amount you want to keep there, or the SCR portion would be used to kind of cover for this liability, because otherwise the insurance company will go bankrupt, and many insurance company has gone bankrupt, right? We have recently seen merger of Exide with HDFC. So obviously when they the conditions are not good, they are not able to make profit, so they has to kind of merge with another company, right? So that's how it happens, right? If your expectation is, if you are expanding too aggressively, if you are not keeping enough reserve liabilities, then there you will hit a situation where the profit will be less. Shareholder would not be required, would be interested in pumping in more money, uh, considering that a lost cause, and then you have to merge with other company, right? So that is the mathematical reason. I hope this is clear. Now let's move on to the intuitive reason why SCR is used, right? So when money is kept aside as a reserve, that ends, shareholder has to finance the claim, right? Suppose there is a very weak claim, you have kept 100 rupees as a reserve, and 1 lakh rupees has came as a claim for some reason, right? So then shareholder has to finance the claim. This means they either they have to pump in the money, so that 90,000 shortfall they have to pay from their own pocket, or have to use the accumulated profit of the previous year. So if you have made 90,000 profit in the previous year, that is sitting with you, then you can use that, right? Either of these two, otherwise you cannot pay for the claim, right? So both this approach are not good risk management technique, because you have not kept, that something like this can happen. The thought process is, that something like this can happen, but you have not accounted for it, you have not planned for it. Actually is a note for planning, risk management. Risk, the basic thing of risk is management, right? So manage, when you can only manage something when you have planned for that. So in this case it is not good risk management, and Solvency 2 is kind of created to improve the risk management. So that is not going with the principle of Solvency 2. So Solvency 2, which is built to strengthen the risk management and thus keep aside a part of the equity or capital for unexpected events, because that's because there is no physical existence of liability. Something might be going wrong somewhere, and that might lead to unexpected liability. And if we know that already, then we have to keep some amount of capital, so that that unexpected liability can also be taken care of, right? And that capital should not be invested in risky asset. That should be invested in regulated assets, so that that capital is protected and it can be used when such situation arises, right? And that's what happened in the entire world when COVID strike. It was difficult. Many companies went bankrupt, but most of the insurance companies were able to bear that blow because they had SCR, right? Because the extra amount that was required, that was kind of paid through by the SCR, because they are already prepared for it. So insurance companies are the most I mean, what can I say? The best risk managed companies in the entire world. Other companies can learn from insurance company. That is also one of the principles that I used in my in my trading channel. That I've learned all of this from the actuary portion of it. Risk management is of paramount importance. If you are not losing money in the stock market, anyways, you are going to make profit. It's very easy to make profit. People just focus on making profit, but you have to focus on limiting your loss, because if you can do that, The rest of the thing is easy. So that concept, that thing that I've learned from the risk manager is a direct application of Actuary, right? So because insurance companies are so strong, right, in the risk management perspective, that's why they can handle this sort of events without most of them going bankrupt. Yeah, of course, one or two who have not followed the good corporate governance, they can go bankrupt, right? But most of the companies who are following those process, who are getting audited, very difficult for them to go bankrupt, right? Because of such unexpected events, they can handle one or two unexpected. Yeah, if the unexpected and keep on happening, then obviously anything will happen, right? All companies might go bankrupt, but that the expectation is these are called unexpected events because they will occur only once in 100 years, right? So they cannot occur every 2 years. That's why for if that happens, the risk management will already the risk margin will take care of it. If something is happening every 2 year, then that is part of the expected liability and not unexpected, then that risk margin will take care of it. But if it is extremely unexpected, then SCR will come into picture and take care of it. So I hope even intuitively you are able to understand, right? So that's the end of this video. I hope you understood the concept. And thanks, Karthike, for asking this question. I took some time to answer this, but these days I'm a bit busy, and yeah, I try to post one videos every time, because I have seen that somehow the people who some initially I get a lot of views, but then after a point of time, people are once again focused on clearing papers. This concept of this is very difficult to get people away from clearing papers and to force them to kind of get to the knowledge section. I have understood that some people will always be like that, and you can't do anything about that. They will always come and share their result in LinkedIn saying that I have got this much marks, and when they would be interviewed, they will say term product has maturity benefit. Nothing can be done about that, right? But yeah, that's why I believe that also the my videos are so conceptually heavy that I believe some amount of time would be required to kind of grasp those, right? Yeah, I'll always ask you to be a proper actuary and not a paper actuary. And if you believe in that principle, right, and if you are benefited by this video, if your concept got clear, please hit the like button. If you are seeing this video for the first time, then I create this sort of videos. One video would be released, at least one video would be released every week, and in my channel. So thanks for watching this video. If you have any comments, let me know in the comment section of YouTube, not in LinkedIn. And thanks for seeing this video, and see you in future videos.